Ron from Ronald Law, and in this video, we're going to talk about the differences in lease terms, okay? Primarily between long-term rentals and short-term rentals like Airbnb, or even longer commercial leases that are 3, 5, or 7 years long, corporate rentals, or anything shorter like student housing. Ron from Ronald Law, and we're a full-service law firm that helps real estate investors maximize their return. In this economic climate, rising interest rates, unknown inflation, and who knows what the next 2 to 3 years is going to look like, it is more important than ever to understand lease terms. And I say that because this video is going to walk through the pros and cons of different lease lengths, as well as some of the other risks that you take when you adopt different lease terms, okay? So let's very broadly start with, what am I talking about? Okay, they say, Ron, I want to know about long-term rentals or short-term rentals. Am I going to be doing a year lease in a house, or am I going to put it on Airbnb and make possibly 5 times as much with a short-term rental? Now, this video is going to talk about how to make that decision, because I think this is really true at all levels of investing, okay? On the extreme short side, you have daily rates. I won't go into hourly motels. Those are not allowed for this video, but let's talk about daily rates. And if you have an example of a hotel, a motel, or an Airbnb, you are able to book and collect revenue on a daily rate. Now, this typically represents the highest rental value for your real estate, real property, just because it's so short. And because there are not necessarily bookings in advance, you get to charge the highest daily rate. Also because it's the highest rate of risk, right? We're talking discretionary travel, we're talking about business travel, maybe luxury stays if somebody's doing a staycation. Furnished rentals, they charge the highest daily rate, right? We're talking $300, $400, $500 a night, maybe $1,000 a night for a big house. But that represents the highest return and the highest risk. Now let's look at the flip side, okay? I have a lot of investors that are long-term investors, right? These are people with significant assets. You really are busy doing something else, whether it's your day job, you're retired, managing your money, whatever, and you want long leases to mitigate your risk. And these are going to be your 10, 15, maybe 20-year lease terms to really established tenants. Maybe they're publicly traded, they're credit tenants, and they want a long lease, right? So we're talking like the freestanding triple net, CVS, Walgreens, Starbucks. Everybody loves Starbucks. And to a lesser degree, you're starting to see very long leases on just regular industrial buildings, right? So Amazon or FedEx or UPS, they're going to be signing a 10-year lease, maybe a 12-year lease. And those also represent a significant lease term where you're mitigating your loss while also capping your upside, right? So for these trade-offs, you have to really decide what is your risk tolerance. The lower risk tolerance is going to have fewer opportunities for upside. You have to wait until the lease expires and you can mark to market, which is raising your rents again, to unlock more value in the property. But it really just depends on your risk tolerance and how much work you're going to do, right? So let's go back to maybe more of a middle ground, which is what residential investors would call long-term leases. So if you have a multifamily building, a really popular trend now, and I represent several clients who are doing this, buying hotels, right? Either buying vacant motels, low occupancy motels, buying hotels, and setting aside a portion for Airbnb. And it's a little bit a different approach, right? Because for a long time, the traditional hospitality real estate approach has been to buy an underperforming asset and to raise it into national flag standards, to get onto a reservation system that really increases your rates and increases your demand and ultimately increases the value of the property. That's been a traditional approach. However, you have now these short-term rental operators that are really good at hospitality. They're really good at understanding The business, either it's through their own website, the direct bookings, maybe it's through Airbnb, VRBO, other platforms, or even just word of mouth. They're really good at creating an amazing experience that everybody wants to share with other people. Bottom line is, if you know how to bring people into that hospitality stay, you need bigger and bigger platforms to scale. Instead of just buying 1, 2, 3 units, maybe even clustered in a destination, you want to buy 12. You want to buy 20 because you have a lot of confidence you can fill 20 units. And in addition, the benefits from scaling in a single property is housekeeping. You can afford a full-time housekeeper at that point because they're just moving around from unit to unit every day to do the linens and do the laundry and that sort of thing. Again, once you get to a certain level of scale, you're going to have consistent needs for maintenance, for handyman requests. And there's a lot of benefits and a lot of reduced operational costs when you reach that level of scale. But I would still say that, again, hospitality, hotel owners, STR to a much tinier degree, right? A one-off is basically essentially owning one hotel room in an area. But these people are taking the highest level of risk. And what we've seen in this current economy is just crazy inflation. There's a lot of risk. And we're seeing some of these operators get burned because when you're doing these short-term rentals, you have to constantly understand what your expenses are and adjust your pricing to maintain your margins in light of higher expenses. So let me just give you an example. You have a budget for, the electricity bill on your unit, and it's pretty consistent. It peaks in the summer, it goes down in the winter. If you're in Texas, someplace like Austin, your max usage is going to be in the hottest months of the year, but you budget for it and you reflect the price when demand is higher. I get it, it's good. With this latest inflation, electricity prices have gone up like crazy. You may or may not have a fixed contract term with early termination fee, but also the usage has just gone up drastically. And I see a ton of operators complaining about $500, $600, $700, $800 electricity bills because every guest that comes in, they're cranking the AC down to 63, 62, whatever the lowest setting is, and they just leave it running constantly during their stay. Now, some operators have the ability to set a minimum, but a lot of them don't. And so you are basically just banking on an average electricity consumption. And now with inflation and increased demand and temperature, you are subject to some changes that you're not able to mitigate. And suddenly you're, $2,000, $3,000 a month of profit. You've just cut that by a third because of your unexpected utility costs. So that's exactly the type of example that can occur at all levels, right? We may have another COVID surge. I don't know what the latest iteration is now, guys. I really lose track. We're on ZZ, XY, COVID variant, but it's coming back. A lot of people are getting sick. Is this going to put another damper on travel? Is it going to hinder some of these hospitality stays? And we don't know, right? That's the thing. We don't have control over it. But you, as an investor, you have to make a conscious decision that this is a risk that I have the ability to mitigate. I can analyze it. I can maybe fix some of my costs. And otherwise, I'm just going to accept the risk of other costs going up and other revenue going down. The key difference is the length of the lease. Is if you are unwilling to take some of those risks, you might put in a long-term tenant, right? You might be better suited for a multifamily building. You may want to do build for rent with long-term leases, because at least with those types of leases, yes, you are getting a rental increase, right? So you are capturing some of this demand, but you're not getting the 5x, 3x revenue risk of short-term stays. You're capping your upside because your tenant is still going to be paying their own utilities. They're going to be paying for landscaping, all those things. But as an owner, you still have some risk, right? The main expenses will be, your mortgage, which is hopefully a fixed rate as opposed to a variable rate debt. Property taxes go up. That's always an unknown. And insurance costs go up. That's typically about it. But there's still a degree of risk mitigation, risk management with a long-term lease. And so really, I just want to wrap up this video by saying, what is your risk tolerance? And the question of whether you want short-term rentals or long-term rentals It depends on your risk tolerance. And if you're even more risk averse, you may move into longer commercial leases that are 3, 5, or 7 years long because you want to really mitigate, right? Triple net is another step of risk mitigation where the tenant is responsible for 100% of the property taxes. They can double, they can triple, the tenant remains obligated. Insurance, another big ticket item, right, that I talked about on the residential and multifamily side. Insurance costs, 100% of those costs get passed to the tenant. To some degree, right, because of that long-term lease, your upside is fixed. Your return is going to be capped at that long-term lease rate. However, once that lease is up for renewal, you can unlock more value by renewing. And so the main difference is, what is your hold horizon? One of the things I love about short-term rentals, hospitality or Airbnb, whatever, is the ability to turn off and on your rental product. And so what I mean by that is I have people that are renting out, say, like a beach house or their own lake house that they seldomly use. With Airbnb, you can just turn it on. It's already furnished. If you know how to run the business, you can run it for a few months to get revenue, but then you can turn it off as well. Same for just even a residential house. It's very easy, and you're not locked into a long-term lease. You can turn it off and you can sell at a moment's notice. So that's something that's very appealing, is that flexibility with the short-term rentals. So again, you as an investor, you need to decide, how committed are you to your hold period? I'll say that again so you guys don't miss it. How committed are you as an investor to your real estate holding period? Really important, because if you tell me that you're committed for 5 years, that really opens up the world of options, right? You're able to buy more aggressive properties, you're able to make more capital improvements, and again, you're willing to buy maybe a longer term lease, because if you're willing to hold it for 5 years, the guy might have 3 years left sub market, but you're willing to pay for it and hold it, because then when it renews, you're going to unlock a lot more value at market rates. Thanks for watching this video. The difference between short-term rentals and long-term rentals, purely from a legal perspective, it comes down to the length of the lease that you're willing to handle and the corresponding risk. The shorter lease commitment that you have, the higher the risk. And so you have to decide, can you mitigate that risk? We're seeing all sorts of changes on the Airbnb platform, reviews, refunds. I personally hate it. I think that you just have no control when you put it on the platform, but that's a video topic another time. So smash that like button. Thank you guys for watching, and we'll see you next time.